My name is Yigal Marcus. I'm the director of BERNSTEIN in Tel Aviv. Let me take a minute and just introduce our firm to you. BERNSTEIN is a global asset manager. We manage almost $500 billion globally for private clients and for institutional clients. About half of that is in fixed income, and the remainder is in alternatives and equities. Bernstein is famous for its research. Bernstein research, it's well known here in Israel, but it's also known globally. And the reason why clients like us is because we don't have any other business that we're involved in. So we don't do investment banking or commercial banking or really any business that can conflict in our core businesses of managing money and doing investment research. So when our clients buy our research or ask us for advice and we look them in the face, they know that they're getting an opinion that is unconflicted and is based on digging deeper and trying to find kernels of gold in what is otherwise a very crowded environment. The firm was founded in 1967 by a man named Sanford Bernstein, also known as Zalman Bernstein. Mr. Bernstein founded the firm on the premise that he wanted to provide institutional quality money management to private investors. And the way that he was going to do that is to create what we call an information advantage. We're just going to dig deeper and do better research than anybody else, and in that way find the opportunities to be able to create returns for our clients in the long term. And we've done that, and about 2.5 years ago I approached the company and told them that we really should consider opening an office in Israel. It's a little strange to be a firm called Bernstein and not be present in Israel. Today we manage about $2 billion here in Israel alone and growing. So that's the firm. I have to just put this disclaimer. This is actually very important for us. I'm not offering any securities here today or any products. And so all I really want to do is to talk about our outlook on the high yield sector. A couple of months ago, I was at a meeting with one of the big institutions here, actually more than one, 2 or 3, that when we started discussing high yield, there was a real fear of investing in high yield. And that was very different than 2 years ago when everybody here was interested in investing in high yield. And obviously what's happened between 2 years ago and today is the fact that we've had a major sell-off in the high yield sector, and trying to understand what has happened and the opportunities that there may be in this sector could create returns for our clients and for anybody looking at it. This is just how high yield lagged in the fourth quarter. It closed down last year, and it was triggered by oil, right? Oil sold off, and as a result, all the exploration E&P companies, exploration and production companies, sold off, and obviously there was a spike in defaults. But that doesn't mean that you should be afraid of this sector. In fact, what we've seen historically is that when there have been periods of sell-offs in the global high yield market, very often there are strong rebounds thereafter. And we're seeing similar opportunity today in this sector. Yield to worst is, if you don't know, is a metric which basically measures the opportunity in the sector, which measures the yield to a worst case scenario short of defaulting. And yield to worst historically has been a very good indicator of 5-year annualized returns looking forward. A few months ago, when there was a very deep sell-off, February, the yield to worst was 10%. 10%. That means that looking forward, it would 5-year annualized returns in the sector reliably have been, around there. Today it's about 8.5%. But when you think about potential returns in alternative strategies, And what we recommend our clients is that whenever you invest in global high yield, you should source it from your equity allocation, because the risks of high yield are similar, certainly to equities than they are to traditional fixed income. But when you think about an 8.5% potential annualized return over the next 5 years, and you compare it to what we think annualized returns are for equities, it's very attractive. We think that looking forward, returns for equities globally are going to be somewhere between 6 and 8%. So 8.5% in the high yield space for a sector that has less volatility than equities actually looks very attractive. And the reality is that defaults still remain low in comparison. Obviously, there was the TXU deal, but historically, we haven't seen the kind of spikes that we had in the past. And even with defaults in the commodity sector and energy sector, they're still low. And we think, that really triggered what was the concern. Are we reliving what high yield went through in 2008? And if you remember, 2008 was not a good year for anything, quite frankly, except cash. But even there, it had some negative rates. But certainly, when it comes to high yield, it was a very bad year. And it's short on the memory of investors. And so when the market started selling off significantly, people were concerned. Are we living through 2008 once again? And we don't think so. We think that what we're going through is something a lot closer to what happened in the telecom industry right after the dot-bombs in the early 2000s. That what you saw at that time when there was the dot-bomb bubble burst is that there was a big sell-off, but it was a sell-off that was limited to a particular sector, telecom, a little bit of spillover into other sectors, but that it was relatively contained. And we think that what's happening now with energy is going to be very similar. There was a little bit of an overreaction in the market in terms of the entire sector being sold off, but we do think that when you dig deeper, the threats, the dangers are really focused on energy. Now, 2 years ago, we came out, the person who runs our fund is a gentleman named Gershon Distenfeld. He's actually went to high school with him. And his particular fund was the top-rated Lipper Global High Yield Fund with 10-year track records for 4 years in a row now. And 2 years ago, he made it to the news, which he's now in front of a lot, because he said two things. Number one, he said at that time that investors, in trying to generate yield, were reaching. And they were reaching to CCC, to real junk, to the certainly the more dangerous securities that were out there. And he saw a little bubble being created because people were just desperate for yield, and so they were going after CCCs. And he got up and he said, it's a big danger, don't do it. Don't reach for yield. And the second thing he said 2 years ago was that the energy component of the high yield index became large. It became large. And that's what you see over here. And telecom was the largest sector in 2000. It was 24.6% of the high yield index. Energy was 15.7%. And he said, and our modeling basically revealed that it was 15.7%, but it was way too reliant on the price of oil. Just 2 years ago. And then oil was still relatively strong. But he came out and said, be careful, be wary. In his particular fund, he de-risked, and his allocation to energy was closer to 5%, even though the index was 15.7%. And he turned out to be right. People were reaching and to CCCs and overweighting to energy, and that was a danger. But it doesn't mean that because one sector is sick, that everyone's going to catch the flu. It is limited, we believe, into one particular sector, and we can see high returns in environments where there are high defaults, especially where defaults are limited to a particular sector. And we think that that is likely to continue. And the reason why we don't think this is 2008 is because one of the things that we look at is excess, right? When investors crowd trades, then you know there's a problem. I have every investor that I know, here has been asking me about investing in New York City real estate. When everyone's asking to invest in New York City real estate, that's a little bubbly. Excess is when everyone's crowding a trade. And right now, 2008, there was a lot of excess. We don't see it today. It's another indicator why we think that investing in the high yield space is better. Remember, as I mentioned before, triple C issuance is actually lower, but it had been on its way up, which is when we came out and said, be careful, be careful. And it has tapered down a little bit, but we think that, again, there is no excess. And if you're selective and you really think about doing the research and trying to identify where the opportunity is, there are significant opportunities to be found. So in 2008, everything did terribly. But in 2002, again, the period of time that we think is more similar to today, there certainly were particular sectors that did well, and we think even in today's environment, there are sectors that will do well. And even within energy, at some point, valuations are going to be awfully attractive if you can be selective. And this is just another indication of why we think there could be environments. Dispersion has increased, spreads have increased. When spreads increase, you want to be buyers, not sellers. And we would continue. We are advising folks to stay away from triple Cs. There could be more downsides. Defaults tend to increase in pockets, so we're advising them. One of these strategies that we think in this kind of environment with heightened volatility that could thrive and has thrived, quite frankly, is low volatility high yield bonds, whether it's shorter duration or whether it is just lower volatility bonds. They've actually done very well in the rebound that we've seen since February. In the last month or so, they did rebound, and they did a lot better with a fraction of the volatility. So if you want exposure to this space, we think that one place to look is potentially a low volatility high yield portfolio. Our bottom line here is when there are corrections, sit tight. If you look at this chart, this is very interesting. If you look at this chart, you'll notice that when high yield sells off, the months to recover the losses can be relatively quick. 4 months. This was actually a lot sooner, right? We made since the end of February we came back and actually we're having a pretty good year right now. But whenever it comes to selling off high yield, your natural inclination will tell you to sell, get out of it. And what we tell our clients is to sit tight, because historically these things have done better and have rebounded and bounced back pretty quickly. And this is just as you actually I'll leave that up for you. But as you can see, the green is the rebound. So when they go down, the bounce back is pretty significant. And to make sure you took a picture of that. And the other big issue, I'm going to conclude with this, is liquidity. Liquidity has been a very big issue in really the entire fixed income universe. And there are ways to take advantage of liquidity issues. And it's part of what we do. In our firm, we have traders and analysts who literally sit at the same desk. And traders almost become analysts amongst themselves and have been trained to take advantage of liquidity problems in the fixed income market, which aren't going away anytime soon. Okay, and I think I'm going to stop there. This just talks a little bit about what happens during high yield when the Fed raises rates. They tend to do well, and so there's no reason to be afraid of that. But it is important to go back to your portfolio and to reevaluate your particular risk tolerance. And again, this could be a very interesting option for those of you who want to try to get equity-like returns, but with less volatility in an environment which we're expecting heightened volatility going forward.